Unless all your money was in the G fund, your thrift savings plan has probably seen some significant drops in 2022. The drops hit both bonds and stock funds alike. And all the experts out there can tell you what happened and also what's going to happen in the future. The problem is, they're probably wrong. In this episode, we're going to define the terms bear market and recession. We're going to look at what this means to you, and I'm going to share you some tips of what you should be doing with your TSP now that we know what's going on. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on your complex and often underutilized benefits. Now, once you finally got access to your thrift savings plan after the big debacle of the change in the website, people were finding some really bad news about their portfolios. Through the first half of 2022, both the bond funds and stock funds went down drastically. And when I say bond funds, I'm excluding the G fund because that is a stable fund and didn't lose anything. So the first half, we lost a lot of money. Now, in the month of July, we did have some recovery in some of the portfolios. So that was good, but they're still down drastically from the beginning of the year. We've seen this from a lot of clients, and we've talked to a lot of them about what's going on and how they feel about this. And we're going to talk a little bit about this over the course of the video. According to fedsmith.com, 249% increase to moving money to the G fund in the month of June alone. This means that people are scared and they're running to shelter. Is this the right thing for you to do? It could be, but more often than not, it's already too late to make this change. So let's dig into what these definitions mean. Investopedia defines a bear market as when security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Well, we definitely have the widespread pessimism and negative investor sentiment, and we definitely had seen the 20% drop in the S&P or other portfolios. Investopedia further states that the Dow Jones Industrial Average has had 34 bear markets since 1900. This would be the 35th. This means they average about every 3 years. So it's not so uncommon to have a bear market. But we want to be able to look a little bit more about a recession because we're also talking about that. For this, we're going to jump over to Wikipedia. Now, Wikipedia has had a lot of changes over the last couple months. It's a staggering number, over 300 changes to the definition of recession alone. So while this is the definition that we use, it's constantly changing, or it has been constantly changing since different people are deciding if they want to call it a recession or not. Either way, we're going to look at how it is going to affect you. So let's look at that definition. The practical definition is 2 consecutive quarters of a decline in a country's real gross domestic product, or real GDP. Official recessions are defined by the National Bureau of Economic Research, or the NBER. So we haven't officially been called a recession yet, even though it has met the definition of a recession that has been commonly used for many, many years. So you have to be able to look at, is it a recession for you or isn't? Personally, it's just a definition. Are we in a recession? I think so. I think all of the signs say so, even though unemployment is not meeting that definition. Since 1980, the US has had 5 recessions. What this means is that we have a recession a little bit under every 10 years. So not as often as a bear market, but still, they're not uncommon or something that we think that never happens. They do happen about once a decade. Over the many decades that I've been working as a financial advisor, I've seen quite a few similarities in these different bear markets and recessions. When we're looking at these similarities, it doesn't mean that we know what's going to happen over the next course of a couple years or whatever. They're always different. They're always formed for the different reasons, and they always have different outcomes. There are some things that we look at that do affect people on a lot of different ways. The first thing I want to address is that when you're looking at a bear market and a recession, they are purely just definitions. Some economist made a decision of this is what it's going to be, and a bunch of other people agreed along that that's what we're going to call the definition. Now, in a bear market, when they say it's 20%, they could have said 25%, they could have said 18%, but they stuck with the number of 20% because it's easy. Whatever it is, we don't care necessarily if we're meeting the definition of how it affects you personally. What we're looking at is a lot of different factors. The recession or a bear market will affect you, but probably in ways that you're not looking at it. We don't care as a general population or as a person living their life if we're in a bear market or recession. But companies do tend to look at this. The way that these affect people is that companies will shut down or slow down what they're doing to protect themselves. We got a call this week from a client that was actually laid off on the day that the GDP was announced that it was negative. This means that most likely they were planning before we hit that definition of a recession, and they were planning to be able to do this. It just so happened that it was on the same day that we hit the definition of the recession. Now, we probably will not see the last of this. We'll probably see a lot more layoffs and slowing down of hiring going on. This is how a recession and bear markets affect people. Most people, like I said, don't care about the definition if we're in it or we're not. Now, we as a company are looking at what to do in a recession as well, but we're just looking at it in a different way. For us, we're looking at it, how can we protect the people that are going to be possibly going through very hard times? They're going to be trimming their budgets. They're going to be making sure that they're not overspending. So there could be things that are going on. Again, we're making a big assumption that we know what's going to happen and this is going to happen. I would rather be prepared for a recession and it not happen than not be prepared and have the tools to help people get through this very tough time. Because if we do go into a recession, it could be for a long period of time, which means it could be affecting families in a very bad way. I want to get back to these experts that are out there spewing a lot of information. They're telling us that they know exactly what's going to happen in the future. Well, we really have two different camps of these people out there that are telling these things to say. First off, we have the people that are not as educated as they probably should be or licensed, and they probably don't have any credibility at all. And then we have the very highly educated people that probably have lived through things and really believe based off of their analysis of what's going to happen. The first group of people, you should never listen to them. They aren't backing their information off of history or a long time of knowing what's going on. The second group of people, the educated or licensed people, the people that do this for a job and that's all they do, they're not trying to be an influencer by any means, they probably really believe of what's going to happen. The problem is all of them are probably wrong, or 50% of them are wrong. And if they do happen to win the 50% coin flip and they're right, we have to look at, are they right for the right rationale? Back in the financial crisis of 2007 and 2009, there was a book that was published before then. It was a very popular book. It was a spin-off of a New York a best-selling book. Very popular financial book. One of them that I like. In this book, they predicted that there was going to be this major drop in the stock market, which happened again in 2007. And the people that published the book or wrote the book, they came out and said, look, we predicted this crash. We are so brilliant. They took all of the credit for predicting this crash. The problem was their rationale was completely wrong. They predicted the crash was going to happen because of the required minimum distributions, because of so many baby boomers retiring and getting older, that they were going to force all of this money out of the markets and it was going to cost the markets to crash. That did not happen. Even though their rationale was wrong and the book was completely false, they still took credit from claiming the crash because they said roughly when it was going to happen. So experts are frequently wrong. And yes, I'm an expert, but I'm not trying to predict or tell you what's going to happen. We're trying to help protect you and try to help give you some guidance so you can make the decision what's best for you and for your family. Let's take a look at your TSP now. When we look at the TSP, you have two choices to make here when you're looking at the allocation. The first one is the current allocation of what your investments are currently invested in, and the next one is your future allocation of what the new money going to the TSP should be invested in. Let's first look at your current allocations. Now, the best time to change this allocation is when the times are good, when you're not having emotion or being worried that the market's going to keep crashing. Well, it's too late, and if you haven't done that already, you have to make a decision of, do you want to hold on or not? And again, I'm assuming that it's going to go down. If things go back up, no worries here at all. So one of the things you want to be able to look at is, if you did not change this before, is it too late? Well, we're still riding on some pretty big highs, even around 20% down in the markets. So it would be okay to change this, but if you're looking to try to recover or protect yourself, it might have been too late already to be able to look at this. So what do you do if you don't have an allocation that you feel would be good going into this? The first generic recommendation I can make to you is that you only move the money that you absolutely need to get to the period of time that you think the market is going to be down. Let's take, for example, that you need $2,000 a month to offset your retirement needs besides your pension and Social Security. So you need $2,000 a month, which is roughly $24,000 a year. Let's just call it $25,000 for easy math. Now, you can plan out for a certain period of time of whatever length you feel you want to protect. Maybe you want to have income for the next 5 years. Maybe you say 10 years. So if you want to plan for a 10-year cycle, you want to take $250,000 out, the $25,000 per year times 10 years, and that would take $250,000 out and then put it in a relatively safe type of investment. Now, this could be from the bond market or the stock market, either way, or wherever you feel you want to be. 10 years might be a little obsessive, but if that's what makes you feel good, then taking out that $250,000 can protect that money until the markets can recover and you safely feel you'll be in a good time for that. I highly recommend that keeping anything else besides what you absolutely need should stay invested at this point. Now, what do? You just ride the roller coaster. Statistics have proven over many decades and even a century that the best thing or the best type of asset classes is generally equities, meaning that equities outperform bond markets, cash markets, and everything. So the problem is riding that roller coaster, the ups and downs and the volatility that's going to happen, and that will continue. What I suggest is because you have that safety net, that 10 years of income, you can ride the roller coaster a little bit easier knowing that you have a lot of safety to get you through this cycle. It's not going to be good. It's not going to be pretty, but at least you know you have some safety and you didn't liquidate everything. Because like I said, any expert is probably wrong. I do not know if the stock market is going to go up or if the stock market is going to go down. What I do know is it's probably going to be very volatile and most likely it's going to go down. But I do not know. And so you have to follow, again, what's best for you. The next area that you want to be able to look at is future allocations. Do you make this go all safe or do you keep it where it's at? And again, not knowing specifically where you are, my recommendation is that if you want to be able to take advantage of some opportunities, maybe you look at future allocations and put that into the more risky type of investments like the C, the S, and the I. By doing this, what you're doing is you're buying on a discount. Every new paycheck that you put into the TSP or a portion that you put into the TSP, you're buying at a cheaper price than it was before. So let's say the markets are 20% off right now. You're buying at a 20% off discount than what it was at January 1st in 2022. That's a pretty good price. I would take a nice 20% discount. Again, you're looking at the long-term nature of this. If the market goes down 50% or 60% off, you're buying cheaper prices as it goes along the way. Well, what happens if the markets go back up? Well, in that scenario, you got some money bought in at the 20% off price, and you were buying as it crept up over a period of time. Either way, I think that a future allocation should be a more aggressive stance, and the current allocation should be a more conservative stance with the money that you need for safety. But at this point, anything else, just let it ride. Again, it's going to be discomforting, but you'll get through this and probably a little bit better at the end. It's just not going to be a fun ride on that roller coaster. The last recommendation I can give you is to really find out what your risk tolerance is. We have a whole video on asset allocation. Here's a link to it. Just go and check this out. We don't need to reiterate everything that we talked about in this video. It was very good and it talked about it. There's even some free tools that you can find and use if you want to find out where your risk tolerance is. Again, do you want to make the changes? That's up to you, but at least you'll know your level of risk and the tolerance that you have for the changes in the volatility that's probably coming in the future. If you're still watching, hopefully this has been very valuable for you, and hit that like button so we know to create more videos just like this. And we're going to be here through this whole cycle to help you out. I want to go over a couple of quick points here though. Financial professionals do not know which way the market's going. No matter how many different people you listen to on TV or on social media, they don't know the answer. They're making an educated guess and hopefully they get it right. You need to do what's best for you. If the emotional discomfort is too great, you need to take some money to safety, but please don't liquidate everything. Yes, it could be the best solution in the short term, but you probably don't know when to get that money back invested, and that could be the danger. is that you take it out and it stays out for 10 years and you miss the upside when the markets do recover because they have always recovered in the past. I can't say they're going to recover in the future, but statistically it will because they've always done this in the past. We want the best for you and your family, so please get conflict-free, unbiased advice. Thank you for your time today, and we look forward to helping you in the next video.